Let's hope you're well. So, we just had something happen that only occurs when a recession, if not economic depression, is imminent. So, as you know, on this channel, we've been talking how it's almost inevitable once we get these yield curve inversions. But now, what the market is telling us is that it is imminent. And really, the experts, the billionaires, the hedge fund managers, the guys on Wall Street, they really can't believe, they're absolutely shocked at the price action in the yield curve. So let's go right to Jeff Gundlach himself, the Bond King, talking about this. So, Josh, are you going to go ahead and play that for us?
You have to be the one to play it because it's your sharing your screen.
Okay.
But I do think that one of the indicators that had not been signaling a recession was the yield curve was getting steeper and steeper. And in all the past recessions, going back for decades, the yield curve starts de-inverting a few months before the recession comes. And so since we were at peak inversion last week, it was unlikely that we were going to go into a recession even in the next 4 to 6 months. But at this point, with the de-inversion happening, the 4 to 6 month time window is starting to seem much more plausible.
Okay, so let's stop it right there and let me explain exactly what he is saying, because this is what we all need to be paying attention to right now as we speak. So, Josh, let's go over to the chart, please, of the 10-year minus the 2-year. So let's go ahead and make that bigger, please, so we can see it. Okay, thank you. And I want to highlight right at the end what Josh is pointing out. This is the yield curve actually steepening. So the delta between the 2-year and the 10-year is decreasing. Now, what's important to recognize is that this always happens right before we go into a recession. But it always happens because it can happen two different ways. The yield curve can steepen by the 10-year treasury moving up in relationship to the 2-year, or the 2-year moving down. Now, Josh, go ahead and click max on that chart, please. And what you can see is exactly what we're referring to, that before every single recession, and what Gundlach was referring to, we see that yield curve steepens. But again, I want to put, in other words, that blue line goes from under the black line, which would indicate that it's inverted, and it starts going up back towards the black line, and then goes past the black line, and that's when we always get the gray shaded area, which means economic recession / depression. So now go back to that original view, please, Josh, like the 1-year view. Okay, and we can see that the yield curve is now doing the exact same thing. But to be even more specific, it's doing it in the exact same way that it always does it, right before we have an economic crisis. Let me just to make sure we're all on the same page. And what it's doing specifically is it's not just steepening, but it's steepening by the 2-year coming down closer to the 10-year. So, Josh, please throw up a chart of the 2-year treasury yield. And let's zoom in on that. Okay, so that's the 2-year. Okay, good. So now let's go ahead and go to the last 5 days. There you go. So we can see this go from roughly 5% all the way down to where it is today at 3.9. And this is real time. Earlier in the day, it got down to like 3.7. or 3.75. So we started off with the 2-year inversion and the 10-year, starting at 5% for the 2-year and call it 3.5 for the 10-year. That was last week. So 150 basis point delta. And now that 2-year is just plummeting and going straight down towards the 10-year, exactly what you would expect to see when we were right on the brink of an economic collapse, recession, depression, whatever you want to call it. So what we really have to pay attention to over the next few days and the next few weeks is when does the 2-year cross back over the 10-year? Can you put, and you got the 10-year up there, Josh? Okay, so the 10-year, like we said, right around 3.5%, to be more specific, 3.47%. So the 2-year got real close to that today. So we're going to have to monitor this and see when the 2-year goes down below that 3.47 yield currently on the 10-year. And once that happens, then you know you're not, that recession, depression, collapse, whatever, is knocking at your door. And so now is the time that we need to start preparing. What's the number one rule in investing? Just don't lose money. So if you've got, I can't tell you how to invest, but right now in my personal portfolio, it's time to have as much dry powder as possible. And I don't want any exposure to any risk asset whatsoever. Because, yeah, the Fed might lower rates, but if the Fed is lowering rates, that's because the world is on fire. And I don't care how bullish the Fed lowering rates is for stocks. At a certain point, they still come down. And I'm using stocks as a proxy for all risk assets. Let's go back to the cerveza sickness. Remember when the Fed had that emergency meeting and they cut rates all the way down to zero? They said QE infinity, and they're going to allocate or commit to up to $1 trillion a day in the repo market. What did the stock market do? Did it rip higher? No, it did the opposite. The next day, it's down by approximately 1,500 points. So did the Fed put work? The Fed dropped rates. So did the stock market rip? No, it did the exact opposite because the conditions were so bad, were so hazardous that it doesn't matter what the Fed was doing. In fact, the point that the Fed dropped rates was in response to how dangerous the conditions were. So regardless of what the Fed was doing, the stock market still tanked. And this is my concern with where we are right now. And I'm not predicting that the stock market's going to crash or any of these things. All I'm saying is that in my personal portfolio, I see these risks, these types of risks, exploding. And I am more than happy to just sit on the sidelines in cash and just wait to see how this plays out. And if I miss out on some big return, so be it. So be it. I'm still here to continue to play the game in the future. I'm not losing any principle. And that, again, is the number one rule in investing. So make sure you stay tuned to this channel. We're going to be watching this yield curve like a hawk, so we can hopefully give you the data, the information you need to determine the probabilities of certain outcomes happening in the future, so you can do the best job possible at protecting your portfolio. And guys, if you want more of these types of deep dives from the actual professionals, I would encourage you to check out Rebel Capitalist Pro. That's the investment service or online membership program I have with Lynn Alden, Chris McIntosh, Brent Johnson, among others. And I rarely talk about it, But now we're moving into these times that are obviously so tumultuous that you've got to be as educated as possible. You got to have your hands on the steering wheel. You have to be paying attention. And I don't think there's any better way to do that than with the help, the research, the live streams, the Q&As with those pros like Patrick Ceresna, Brent Johnson, Chris McIntosh, Lynn Alden, etc. So check that out, guys. As always, make sure that you're standing up for freedom, liberty, free market capitalism. We'll see you in the next video.